Recording in progress.
Good evening, everyone. How are you all? Are we all good? Good evening, everyone. I hope you all are doing good. We have started this beautiful journey of financial management, and we have uh, covered a topic of sources of funds and objectives, scope and objectives of financial management in the yesterday's class, right? Now, in this today's session, as you can see the screen, we'll be starting with the topic of ratio analysis. So we have got three sessions for this topic, and that is actually a justice that we need to give to this topic because of the elaborate content of this topic, right? So as I've told you, this ratio analysis is simply financial analysis of a company. So for example, like uh, when you go to a doctor, right? If you are ill, you're having some sort of illness or you're sick, you go to a doctor. What does the doctor do? Does the doctor just look at your face and give you medicines and the prescription, or what is the course of action that a doctor does? Yeah, tell me, what does the doctor do? He'll use the stethoscope, right, and look at for your heartbeat rate, right? The blood pressure will be checked. If he will recommend you to go for blood test, he'll wait for the blood test reports, and then he'll give you appropriate medication, right? Correct? This is what is done. Now, in each of these tests, uh, essentially what was happening is, the doctor is trying to get some numbers. When he's testing, or he'll use a thermometer, for example, right? So on the thermometer, he will read out your body temperature. He'll read out your body, blood pressure. He'll check the heartbeat rate. So all these heartbeat rates are having some standard range, right? The body temperature should be, 37 to 40 degrees Celsius, or maybe 100 Fahrenheit. And, the blood pressure should be, systolic, diastolic blood pressures are there. Heartbeat rate is there. So all of them have got a acceptable range, the range within which the numbers should be. So those numbers essentially help the doctor to identify, what is the cause of the concern, right? And then obviously blood test, he may go for counting your blood cells, red blood cells, white blood cells, all the contents of the blood content, right? So the doctor is essentially undertaking a analysis of your physical health, right? Uh, Same way, when we want to analyze the financial health of a company, right? When we want to analyze financial health of a company, then also we actually need uh, some sort of numbers which will help us to judge as to what we are, in the process. Voice is low. Just let me do one thing. Now I think it should be perfect. Yeah, Tanya, is it perfect now? Yeah, it seems to be good. Okay. So, as I said, we will be undertaking financial health analysis of a company. Now, again, just as a doctor looks for your blood pressure, for your blood test reports, for your heartbeat rate, same way, we would also like to, know certain numbers about a company before we uh, essentially say that whether the company is in good financial health or not. Now, just like in your health also, your heartbeat may be normal, but your blood pressure may be abnormal, right? Your heartbeat, blood pressure is normal, but your body temperature is abnormal. So there will be abnormality, there will be problem in one of the areas of your physical health, right? Maybe your body temperature is high, so you have a fever. So the doctor will give you medicine according to that. If you are having high blood pressure, the doctor will give you, or he's going to prescribe you medication according to that, right? So under that situation, the financial health of a company is also going to be analyzed from different angles. Okay, so there are going to be different set of ratios that we'll be looking at, and the financial health will be, or financial health of a company is also going to be analyzed from different angles. Okay, so that is what we are essentially going to discuss in this entire chapter. Okay, now let's just get started with this topic with a very simple concept. Very simple concept is, before we start essentially with the ratios, we would like to have a very clear understanding about a fundamental balance sheet equation. This is a very basic thing that we all should be aware of. Tell me, how many sides does a balance sheet have? How many sides does a balance sheet have? Two sides. What are the two sides of balance sheet? What are the two sides of balance sheet? Liabilities and assets. If I want to tell about this liabilities and assets, I can say it in a very simple language. One side of a balance sheet is telling you from where the company has got the funds. And the other side of balance sheet says where the company has invested those funds. Can I say that? Like you say that, sir, liabilities should be equal to assets of a company. But I say, instead of saying them as liabilities, let's give them a better name, because I personally don't like this word liability. Neither any one of you would love to know what a liability is, right? So instead of saying liabilities, we'll say sources of funds, and whatever is the sources of funds, you are going to apply it. So the second side is application of funds, right? So sources of funds, and the asset side is going to be said to be application of funds. Now, we have already stated in our previous class, what is the role of a finance manager? What was the role of a finance manager, guys? What was the role of a finance manager? Raising of funds and investing of funds, right? So finance manager is essentially doing nothing but playing around this balance sheet, right? The finance manager is just looking for areas from where it can get the funds. It's just looking for the areas where it can invest the funds, right? Can you broadly say, now, whenever the management is doing this, the finance manager is doing this activity of raising funds and putting them into the application, obviously the objective is to maximize the shareholders' wealth. Quite obvious, the objective is to maximize the shareholders' wealth. So broadly speaking, what could be the sources of funds? What could be the sources of funds, guys? Broadly speaking, let me tell you, there are two broad sources of funds. Two headings or two types of funds which a company can raise. One is definitely the owned funds, right? And the other is borrowed funds. So on the one side, we have owned funds, and the other part is borrowed funds. Any type of funds you say, they cannot be anything other than these two. They'll be either owned funds or borrowed funds. There cannot be something in between, right? So owned funds plus borrowed funds is what your sources of funds is. Now, of course, owned funds plus borrowed funds should be equal to, right? So owned funds plus borrowed funds should be equal to application of funds. Where can we invest our money? We can invest our money into either non-current or fixed assets, right? Or you can make an investment in current assets, or you can just do investments in certain areas which are not related to your business. Now here, when we say current assets, we are talking of net current assets. So owned funds plus borrowed funds is your liability portion. And the other part is non-current or fixed assets plus the net current assets plus the investments. Now remember, these two areas, essentially, we're talking of these two areas, which is non-current and the net current assets. They are going to be said to be, they are essentially called to be the operating assets. Whereas investment is, just for the safety purpose, just for future perspective. You've kept some money idle or kept, parked into some other debentures or bank FDs. Those are category. These two things, which is non-current assets and the net current assets, are your operating assets, right? So they are your operating assets. So owned funds plus borrowed funds should be ideally equal to non-current or fixed assets plus net current assets. Now, before we go ahead, because there will be many terms that will be keep on coming up. So let's just clarify the terms right now itself, so that going ahead, when we look at the ratios, we'll be quick enough to understand what these terms are. From the balance sheet, what do you mean by owned funds? What sort of funds are included in the owned funds? What sort of funds are included in the owned funds? We can say one is your equity share capital, right? Then preference share capital, right? Preference share capital. Okay. And of course, we need to add to it the reserves and surplus. But one important adjustment that we need to take into account is we are going to subtract from this the fictitious assets. We're going to subtract from it the fictitious assets. Now, what do you mean by fictitious assets? Do we know what a fictitious assets is? Preliminary expenses, discount on issue of debentures or discount on issue of shares. So all those cumulative effect is, what is fictitious asset, correct? Correct. So fictitious assets are the things that we are talking of in own funds, but we are going to subtract those fictitious assets, because see, these fictitious assets are essentially not not assets as such, right? But we have kept them on the balance sheet asset side. So those assets are generally not assets. So why should we keep it on the asset side? So rather, what we should do is subtract it from the reserves, because ideally those fictitious assets would have been written off in our P&L, but we haven't written it off. We are still keeping it on our books. So instead of carrying it forward, we are going to subtract it. Okay, that's the first thing that we are looking for. So whenever we say owned funds, remember, we are going to subtract the fictitious assets. If I ask you equity shareholders funds, it will be equity share capital plus reserves minus fictitious assets. Okay, so it's equity share capital plus reserves minus fictitious assets, right? So those fictitious assets needs to be subtracted whenever we say equity shareholders fund. Now, what's the difference between owned funds and equity shareholders fund? The difference is, in owned funds, you include preference share capital, but in case of equity shareholders fund, we don't include the preference share capital. Okay, so fictitious assets is what we have already discussed. It is the those assets like preliminary expenses not written off, or discount on issue of debentures, or discount on issue of shares. All those aspects are your fictitious assets. Okay, so those are actually not your assets, but you haven't written it off. You have not charged it to P&L, and therefore that is still remaining in your balance sheet, and therefore you are going to subtract it. So remember this point, whenever we say own fund, this is what we mean. Then we'll use one more term called as total capital employed. Total capital employed. Now, total capital employed is basically investment that is made in the business. Total investment made in the business. Now, any business entity, there obviously we have a investment made. Now, who makes the investment? There are two categories, either the own funds or the debt fund providers. So when we say total capital employed, here we mean to say this is owned funds plus borrowed funds. So whenever we are recalling, whenever we are saying that something called as total capital employed, it will be owned funds plus borrowed funds. Okay. So just remember these terms, guys. So owned funds, equity shareholders funds, total capital employed. Okay. Then what do you mean by net current assets? Can anyone tell me what do you understand by net current assets? What do you understand by net current assets? Net current assets. Net current assets means current liabilities minus, current assets, my bad. So it's current assets minus current liabilities. So that's current assets minus current liabilities. That is your net current assets. Okay. Anything else? I mean, are we all clear with this part right now? So what is own funds? We know equity shareholders fund, we know total capital employed, we know net current assets. Okay. Then apart from these basic terms, other things are going to be quite normal. So I just wanted you to have a idea about. I just wanted you to have an idea about what all the terms are going to be. Right, so that we are pretty clear with the terms right now. Let's go ahead with the ratio part now. Now, I'll make sure to you guys that we are not by-hearting any of the ratios. Rather, we will be, remembering, we'll be trying to understand the ratios with logic, and we are not required to mug up the ratios. Okay, we'll be understanding the ratio with logic. Conceptually, we are going to remember the ratios. Okay, so let us say we have got a company X Limited, another company is, let's say, Y Limited, and after that we have got, let's say, Z Limited. Okay. Now let's not just take this Z Limited. Suppose I ask you current assets. Current assets, let's say X Limited has got a current assets of 1 lakh. Y Limited is having a current asset of 10 lakh. Which of these two companies do you feel is having a greater degree of solvency or liquidity? Which of these two companies do you feel has got a greater degree of liquidity or solvency? Achha, first you understand what is liquidity or solvency, and then we'll discuss, what is this ratio? So when we say liquidity or solvency, it means ability of company to honor their obligations. So whatever the obligations the companies have, what is the ability of those companies to honor their obligations? So who do you think from here, X and Y, would be in a better position to honor their obligations? first of all, you cannot say that it is X or Y because it depends on what is the amount of your obligation, right? So let me take current liabilities. So suppose X has got a current liability of 50,000. Y has got a current liability of 9,50,000. So we get net current assets of 50,000, and even Y Limited has got a net current assets of 50,000. Can you say that both the companies are having same level of liquidity and solvency now? Are both the companies having same level of liquidity and solvency? Yes or no? No. Because, sir, there is this net current assets is 50,000, agreed. But X Limited has got current assets which is double that of its current liabilities. In Y Limited case, it is not like that. In case of Y Limited, it's not double. Though the gap between current asset and current liability is 50,000. But when we talk of ability to honor their obligations or ability to pay their obligations, that is not the same. Because X Limited is having current asset which is double. Y Limited is not the case. It's not that in case of Y. So here we calculate a ratio called as current ratio. We calculate a ratio called as current ratio. Current ratio is computed as current assets upon current liabilities. Current assets upon current liabilities. So here, if you undertake current assets upon current liability, we get the answer as 2, whereas over here it is 1.05. Right? So current ratio for X Limited it is 2, current ratio for Y Limited it is 1.05. Let us understand what is this 2 mean. What does this 2 mean? Here, the meaning of 2 is current assets are rupees 2 for every rupees 1 of current liability. So this number 2 or the current ratio which is 2, that is essentially telling us that current assets are essentially double that of current liability. So when we're looking at this current ratio of 2, it means your current asset is twice that of current liability. Whereas over here, the current assets are just 1.05. 1.05 for every rupees 1 of current liability. So where do you feel there is a greater degree of safety or liquidity or solvency for the company? Of course, X. It's not with Y. Because in case of X, your current asset is double. So you are having a double buffer or a double cover for your current liabilities. But for Y Limited, it is not that case. Right? For example, how do you say that this is a better scenario, sir? So suppose, for example, we say X Limited and Y Limited, both of them face bad debts, right? So both of them are, let's say, facing bad debts, or they're losing their current assets to the extent of 10% of their value, right? So if 10% of current assets are lost due to bad debts, so suppose if 10% of current assets are lost due to bad debts, can you tell me what will be the revised current asset value for X Limited? What will be the value of revised current assets for X Limited? If I'm saying 10% of what the current assets company is having that is lost due to bad debts, can I say this will be 90,000? So do you have still current assets to honor the current liability of 50,000? Tell me, can the current liability be honored? Yeah. Can the current liability be honored in case of X Limited? Yes. But what would happen with Y? What would happen with Y? Current assets is 10 lakh. Now the revised current assets will become 9 lakh, but your current liability is 9,50,000. So tell me, are you in a position to honor your current liabilities? No. And therefore we say X is more safe. X is having greater degree of liquidity as compared to Y. Right? So what conclusion can we draw, then? What sort of conclusion are we able to draw then? Current ratio, is it higher the better? Current ratio, is it higher the better? Yeah, tell me. Yes or no? Higher the better, right? So current ratio, if it is high, it indicates that we are in a very safe situation to pay our debtors, to pay our obligations. Correct. Now, suppose there is another company called as. I'll just write down the conclusion. The first conclusion that I have is higher current ratio indicates higher degree of liquidity. So higher current ratio indicates higher degree of liquidity, right? Or safer situation, or higher degree of, you call it as liquidity, or you call it as solvency. Correct? Now, suppose if we have another company, Z Limited, which is having a current asset of 1 crore. Okay. And the current liability is, let's say, just 10 lakh. So net current assets, of course, it is positive. But can you tell me what's the current ratio in case of Z Limited here? What's the current ratio in case of Z Limited? What's the current ratio in case of Z Limited, guys? Yeah. Current ratio. Can I say it is current assets upon current liability, which is 10. So here we have current assets of 10 rupee for every 1 rupee of current liability. Does it indicate a better situation, better liquidity than X Limited? Is it having a better degree of liquidity than X Limited? Yes. But is it financially viable? Does it really make financial sense to have such a high level of current ratio? We've got like immense amount of current assets. Current liabilities is just 1 rupees, right? So current liability is just 1 rupee, and you've got a current assets of 10 rupee. Current asset of 10 against a current liability of just 1 rupee. Is it making any financial sense? Sir, it is definitely indicating a greater degree of liquidity, solvency, safety, or whatever you call it as. But then the problem is, sir, such high level of current ratio, it indicates inefficiency. It indicates inefficiency. Sir, how can you say they're inefficient? Because if you're having high level of current assets, what sort of assets are you having in higher quantum? What sort of assets do you have in higher quantity or higher values, because of which your current asset is high? Either you will have high debtors, or you will have high amount of stock, or you will have high amount of cash, right? So we can say very high current ratio indicates three things. One, it can be high level of stocks, or it can be high level of debtors, or it can be high level of cash, right? So you can have very high current ratio, means either you have high level of stock, high level of debtors, or high level of cash. Now, if you have really great level of stock, if you're having great level of stock, what would that be essentially indicating? It indicates that you have selling inefficiency, right? You're not able to sell your products in appropriate time, and therefore your stock is just getting piled up. You're having a greater degree of stock piling up happening, and due to which you're facing the selling inefficiency. Now, high level of debtors, what does that indicate? What efficiency does it indicate? High level of debtors, what efficiency does it indicate? Collection inefficiency. Perfect. So it indicates that you're not efficiently, collecting the debtors, collecting the amount from the debtors, or you're giving very high level of credit to them. What does that indicate? When you have high level of cash in your books. So when you have a greater degree of cash in your books, what does that indicate? Investment inefficiency. Perfect. Because the company is not able to identify, appropriate areas. Company is not able to identify appropriate areas for investment purpose. So very high current ratio is also not good, sir. So you are saying low current ratio is not good. Very high current ratio is also not good. So can I say there has to be somewhere in between which will tell us what is the best current ratio or optimum current ratio. So optimum current ratio is okay. So you should have double current assets as compared to your current liability. That is what your optimum level of current ratio is. Okay, is it clear? Does it make sense to you guys? Yeah. So optimum current ratio should be 2:1. One question to you. What current ratio will indicate negative working capital? What current ratio will indicate that you are having negative working capital? If you are having negative working capital, what current ratio does it indicate? So obviously, current ratio less than 1 means negative working capital, that is current assets lesser than current liabilities. Okay, any current ratio which goes below 1, it indicates that your current assets are having a value lesser than current liabilities. Okay, so I hope this makes sense to everyone. So that's the current ratio that we wanted to discuss. We've covered all the various aspects of current ratio. Now let me take up an example. Okay. Suppose we have a company with some values of current liabilities. Okay. Current assets and the amount. Suppose a company has got current liability in the form of creditors. Okay, the creditors amount is, let's say, 2 lakh. And on the asset side, from the asset perspective, company has got cash and cash equivalents. Let's say 30,000. Company has got marketable securities, let's say 20,000. Okay, then company has got to the tune of suppose 1 lakh. Company is having stock of 1 lakh. Okay. And let's say it has got a prepaid expense, or let me just take stock as 2 lakh, and prepaid expense of 50,000. So if you take a total current asset is 4 lakh, total current liabilities is 2 lakh. Does it indicate an ideal situation? Does it indicate an ideal situation as of now, guys? Yeah. Yes, current ratio is 2:1. So it does seem to be an ideal situation. Now, suppose if creditors ask for money. Now, suppose creditors demand money. Creditors demand is 2 lakh. How are you going to pay this creditors 2 lakh? Which current asset will you use first to pay the creditors? Of course, cash. Right. So let us say we pay them with cash 30,000. Then, of course, we can sell the marketable securities. Right. We can sell the marketable securities. Right. Even after payment of them, even after paying these two items, they still have 1,50,000 due. How shall we pay this 1,50,000? How shall we pay this market 1,50,000? Can I ask money from the debtors? Some of you may say that let's go to the debtors and ask for money. So suppose even if you go to the debtors will say that our due date has not yet been come, right? So we will pay you only on the due date. So now if you're going to really pay only on the due date, that's not possible. So I need to actually, maybe get a bill receivable from the debtors, right? So bill receivable from debtors, or bill receivable from debtors is, let's say, discounted. So we discount the bill receivable. Now bill receivable is 1 lakh. Sorry, debtor is 1 lakh. So let's say after discounting, we receive 98,000. Still we have 52,000 balance yet to be paid to the creditors. How are we going to pay this? Can we really sell the stock? Is it easy for you to sell the stock in the open market and then make payment to the creditors? No, because even if you sell the stock, it may be taken up by the debtor. And again, you will have to lose money on that. So what we mean is, so these two items in our current assets, these are essentially current assets, agreed, but they don't function like current assets. They don't carry out their functions like current assets because they are not easily liquidated. They cannot be easily liquidated because these items are something which I cannot sell it in the market easily and get the money. And therefore, these two assets are, called as non-quick assets. And to have a better understanding of, the liquidity, we will exclude these assets from our calculation, right? Because someone is asking, can we pledge the stock with the banks and get the money? Well, if you are really going to pledge the stock, I mean, if you're going to take a loan and make the payment to the creditors, then it doesn't actually give you sense. Then how are you utilizing these assets for your liquidity? I can take loan anytime, but I don't want to go into that area that I'm going to take a loan and then make the payment to the creditors. I want to see whether my current assets are sufficient to pay off my current liabilities. So these two assets, stock and prepaid expenses, are not something which is feasible, or they are not sufficient enough to cover my creditors. And therefore, there was a need to have a better ratio for measuring the liquidity, and that better ratio is
quick ratio. Quick ratio, or we also call it as liquid ratio, or we also call it as acid test ratio. Quick ratio, liquid ratio, or acid test ratio, all of them mean one and the same. How do we calculate them? Well, the calculation goes as you take the current assets, but from that you remove the non-quick assets. Now, which are the non-quick assets that we are going to remove? We will remove the stock and we will remove the prepaid expenses. Now, prepaid expenses is also something which I cannot use for payment to the creditors, right? So current assets minus stock minus prepaid expenses are excluded. And of course, in the denominator, we still have the current liabilities. Okay. Now, again, this ratio also considers debtors into it. But if we want to make it even more strict, we would like to have a ratio called as absolute liquid ratio, or which is also called as cash ratio. So here we are going to exclude the debtors from our calculation. And in this absolute liquid ratio or cash ratio, we will just consider cash and cash equivalents plus marketable securities, and then we divide it by current liabilities. Okay, so cash and cash equivalents plus marketable securities upon current liabilities, right? Now, one thing I would like to clarify at the very outset, here we are looking for, manufacturing industries. Service industry has got a different set of parameters to measure the performance. We are essentially focusing on the manufacturing industry. Okay. I hope these three ratios are clear to all. Yeah. I hope we are clear. Just quickly, let me just put this on charge. I was lose it. Okay, so we have seen the ratios which are having the short-term solvency aspect. Short-term solvency is what we have considered in current ratio, quick ratio, cash ratio. Apart from this, we are also looking at liquidity from a different perspective. Now, what is the different perspective that we are talking of? Let me just take an example. Suppose your daily expense, or let me just say it like this, cash balance of two persons. So we have like Mr. A and Mr. B. Cash balance with Mr. A is suppose 1,000 rupees, and cash balance with Mr. B is, let's say, 700. Okay, and their cash expenditure per day. Over here, the cash expenditure per day acid test ratio is same as the quick ratio. Quick ratio, liquid ratio, acid test ratio. All the three ratios are just one and the same. Okay, so Mr. A has a cash balance of 1,000. Mr. B is having a cash balance of 700. Cash expense per day of Mr. A is 100 rupees. And cash expense of Mr. B is 35 rupees per day. Can you tell me who is more capable of bearing the expenses on a day-to-day basis? Who is more capable of bearing the expenses on a day-to-day basis? Is it A or B? B. Why is it so? Why do you say that B is more capable to bear the risk or bear the paying capacity? Yeah, 5% expense, 20 days. Okay. So if I ask you, how many days of cash expense is available as cash balance? Yeah, tell me. How many days of cash expense is available as cash balance? Mr. A is having a cash balance of 1000. The cash expenditure per day is 100 rupees. Mr. B is having a cash balance of 700 and cash expenditure every day is 35. With 1000 rupees, how many days can Mr. A continue without withdrawing additional cash? Can I say 10 days? What about Mr. B? For Mr. B, it is going to be 700 divided by 35, which is 20 days, right? So, of course, Mr. A is having less liquidity, whereas Mr. B is having more liquidity, right? So, how many days of cash available? We can simply say Mr. A has 10 days, Mr. B has 20 days of liquidity with them. Correct? So who is more liquidity? Mr. B is definitely having the higher level of liquidity. Something of this number, of this type, we have in our ratios also. Something of this type we do have in our ratios also. So that number, we call it as basic defense interval ratio. Basic defense interval ratio. Just like you said over here, it is cash balance upon cash expenditure per day. Here, the ratio is going to be cash and bank balance plus marketable securities. Marketable securities means those securities which you can easily sell in the market. So cash and bank plus the marketable securities, right? Plus the net receivables. Cash and bank balance, marketable securities plus the net receivables, which is the debtor value. This is what, quick assets you have. So essentially we want to see how much level of quick assets we have, right? So quick assets, that divided by daily expenditure, daily operating expenditure will give you the basic defense interval ratio, right? So here we can say it is cash plus bank plus marketable securities plus net receivables upon daily expenditure, right? So cash, bank, marketable securities, net receivables plus divided by daily expenditure is what is daily defense interval ratio. This is similar to what you have quoted as 10 and 20. So this indicates, this basic defense interval ratio indicates number of days for which operating expense can be paid without further withdrawal, without any cash or without any funding. Without any funding. So without you receiving any other funds, how many days you can really run your business with the available quick assets? That's what we mean by basic defense interval ratio. Okay. So marketable securities means those securities which you can, sell it easily in the market without losing substantial value, right? Now, of course, this measure is always going to be in days. This is always going to be measured in days. So basic difference interval ratio is always going to be measured in days. Now, in the denominator, we have stated daily operating expenditure. Now, how do we determine what is the daily operating expenditure, right? So daily operating expenditure is, computed as, you take your COGS, cost of goods sold. This is your operating expense. Add to it any admin expense, add to it selling expense, right? And remove from this any sort of depreciation and remove from this depreciation and non-cash expenses. So COGS plus admin expense plus selling expenditure minus depreciation and non-cash expenditure. So what we are essentially trying to do over here is we want to get the cash expenditure, right? Or you can also call it as cost of sales minus depreciation and non-cash expenses. Non-cash expenses are those expenses which you are not paying by cash, like provision for doubtful debts, provision for discount, provision for future losses, provision for warranties, or maybe amortization. Depreciation itself is a non-cash expenditure. So those expenses which you are just entering in your books, but you're not paying from your pocket, right? So essentially what we want over here is the daily operating expenditure. Now this is of course considered for the full year. I need to actually divide this. I need to divide this by 365 to get the per day expenditure, right? So selling and distribution, selling expense, when I say selling and distribution, both are there, right? So COGS is cost of goods sold. Cost of goods sold. So for example, let me give you some numbers and try to calculate this basic difference interval ratio wise, okay? We can start with the problems, Shini, once we have, learned certain ratios. Without understanding few ratios, you can't be starting with the questions, because then if you see some ratios over there and you don't know, it will be, a problematic scenario. So we need to look at certain ratios first, and then definitely we do have a lot of practical problems to solve. Okay, now I'll give you some numbers. Try to calculate the basic difference interval ratio guys, okay? So suppose cash and bank with a company is 10 lakh. Marketable securities to the tune of 4 lakh. Receivables are, let's say, 7 lakh. Okay. Then we have, let's say, COGS. COGS is cost of goods sold is suppose 50 lakh. Admin expense is 10 lakh. Selling expense, selling and distribution expense is 5 lakh. Depreciation is 6 lakh. And amortization is 3 lakh. So compute the basic difference interval ratio. Why would you reduce depreciation? Because depreciation would be considered in this, right? Like depreciation of machinery will be included in COGS. Administration depreciation, like depreciation on office assets, would be included in admin expense. Similarly, depreciation on delivery vans would be there in the selling expense. So we don't want the depreciation to be a part of my daily operating expense, because depre is something that you don't pay out of your pocket. That's not something which you pay in cash. So when I'm considering the numerator to be cash items, the denominator also has to be the cash item, right? Yeah. So just give me the number of, give me the answer for this. Calculate the basic defense interval ratio, guys, using these two set of formulae. Give me the number. First, give me what is daily operating expense. Then we can go for basic defense. Daily operating expense. What's the daily operating expense? These are annual expenses. All of them are annual expenses. So first, we need to get the daily operating expense. The daily operating expense will be COGS plus admin expense plus selling expense minus depreciation minus amortization. Okay, so 56 lakh is the yearly expense. I just need to divide this by 365. So 15,342.47 or 46 is the daily operating expense. So what will be basic defense interval? Basic defense interval will be the total of all of them, right? Sum of all these quick assets divided by this number. So 136.87. For 136.87 days, we can continue our operating expenses without need for any further funding. We don't need to borrow, we don't need to take any funding, because we will be able to manage our business for 136 days with the available cash balance. Is this clear? Everyone? Now, suppose tell me, if we have a company which is having a basic defense interval ratio as 100, what do you feel about that company? Is that company more liquid than this, or is it less liquid than this? It is less liquid, right? Because it has a lesser amount of cash compared to the daily operating expense. It has got a lesser amount of cash compared to the daily operating expense, correct? Am I right? Yeah. Correct. So that's the basic defense interval ratio that we were talking of. Now, all these ratios that we have done, first we have started with the current ratio, which was essentially talking of current asset upon current liabilities. Then we went ahead with quick ratio and the absolute quick ratio. And then we had this basic defense interval ratio. Now remember, this basic defense interval ratio are nothing but time period for which you have funds, right? All these are your short-term solvency ratios. All of them are your short-term solvency ratios. And we want to now go ahead with the long-term solvency ratios, because we want to understand how effectively the company can be running without any additional, without looking for the risk in the funding. All these ratios were short-term solvency. Now we want to look for long-term solvency ratios. Okay, so long-term solvency ratios, will take an example to understand what are these long-term solvency ratios, okay? Because that will actually click your mind as to what we are really talking of. Let me just take a summarized balance sheet, maybe. Equity share capital, preference share capital, reserves, and then debt. Okay, so you have total capital employed. I hope you remember what is total capital employed. Total capital employed is just the total funds that we are investing in the business. So equity share capital, preference share capital, reserves, debt, and then total capital employed. So let's say this is the part, and then on the other side, you have application of funds. Application of funds will be like you have got, let's say, some fixed assets. You've got some current assets. Now, of course, from the current assets, we subtract the current liabilities, right? And that gives us the total funds invested. Okay. So equity share capital is, let's say, 10 lakh. Preference share capital, on one side we have, let's say, 5 lakh. Reserves are 15 lakhs, and debt over here is, suppose, 13 lakh. So total capital employed in the business is 43 lakh, against which we have got a fixed assets. I've got a fixed assets of 30 lakhs. Current assets is something that we have of 20 lakh. Current liabilities are 7 lakh. And of course, I'll write this as a negative figure. So in total, capital invested is same 43 lakhs. So this is one of the company, X Limited. Okay. So we have another company called as, let's say, Y Limited, which is having a preference share capital of, let's say, 6 lakh. Reserves are to the tune of 10 lakh. So, and of course, we will have some amount of debt also. So debt is, let's say, 2 lakh, 20 lakhs. Now, fixed asset wise, it is same. We can say whatever we are with regards to this, it's just the same. Yeah. Now, out of these two companies, we'd like to analyze which of these two companies are having a greater degree of long-term solvency. Okay, we'll write down the ratios. I'll give you the definition of the ratio. I'll give you the understanding of the ratio. You will be the one who is going to tell me, what that ratio is. And trust me, guys, you will be definitely be able to answer that. Okay. Yeah. So this is the balance sheet, the summarized balance sheet that we have. Now, we are looking at equity ratio. Equity ratio. Equity ratio is going to tell us proportion of equity ratio is going to tell us proportion of net assets funded by shareholders, funded by equity shareholders. So like I'm talking of the total funds that has been invested into the business is 43 lakhs, right? So out of this 43 lakh, what proportion is funded by equity shareholders? Because total money that has been invested into the business is 43 lakhs. Out of that 43 lakh, how much has been, funded by equity shareholders? Can you tell me, guys, how much has been funded by equity shareholders? I'm talking of proportion. I'm talking of proportion. Total 43 lakhs. That how much has been invested by the equity shareholders? Yeah. So the formula will be pretty simple. Equity shareholders funds divided by net assets. So net assets over here is, of course, 43 lakhs. But what about equity shareholders funds? What is included in equity shareholders funds? What all items are included in equity shareholders funds? Of course, equity share capital, right? So it's going to be equity share capital plus the reserves also, right? Out of your net assets of 43 lakhs. So in case of X Limited, we find that total, the net assets that is invested in the business is 43 lakhs, out of which 25 lakh has been funded by equity shareholders. So proportion wise, can I say this is 0.58 and this is 0.39. And 0.3814 So it indicates the first ratio. It indicates for rupees 1 of investment in the company, 0.5814 has come from equity shareholders. And over here, it is for every 1 rupee of investment in a company, rupees 0.3953 has come from the equity shareholders. So this has come from equity shareholders. Yeah. So out of these two companies, can you tell me which one is having a greater degree of solvency or liquidity or sort of stability? Company A, right? Because if you say 0.5814, company X, the first company, right? Because if you say 0.5814, it means that it has got a greater proportion of equity funding. It has got a greater proportion of funding by the equity shareholders, the debenture holders and preference shareholders having a lesser stake. And of course, like if you buy a house and on that house, the lesser the amount of debt and more of your obligation or more of your contribution is there, and that indicates a safer situation for for any person, rather, I can say. So if someone has bought a house, let's say for 1 crore, and the loan is just 20 lakh with owned funds as 80 lakhs, and the other guy is having 50 lakh as loan and 50 lakh as its own obligation, of course the 80 lakh guy is having a better safe situation, right? So equity shareholders ratio, it's going to tell us proportion of net assets funded by equity shareholder. So numerator is going to be your equity shareholders fund. Now how do you get the equity shareholders fund? Equity share capital plus reserves, right? And this entire portion divided by the net assets. Net assets is basically total assets minus your current liabilities. So current liabilities are subtracted over here. Does this make sense? Are we good with the equity ratio now? Are we good with the equity ratio? Yep. Okay. Now, for these same numbers, if you want to look at another perspective, sir, will we minus fictitious asset? Yes, we will. When you are talking of reserves, obviously it's going to be net reserves. That is after subtracting the fictitious assets. Okay. Okay. Now let's just look at the another ratio which is opposite of the equity ratio. Like here, we said 0.5814 of the total assets is funded by the equity shareholders. So the opposite of that is debt ratio. The opposite of that is debt ratio. Now, what would that debt ratio mean? Debt ratio means proportion of net assets funded by borrowings. Proportion of net assets which are funded by the borrowings. Like in this case, we said 0.5814. We said 0.5814 is the equity ratio. It means 58.14% of the total investment is by the equity shareholders. How much do you feel to be the investment by the debt fund providers? How much do you think will be the investment by the debt fund providers? Yeah. The balance portion, right? Almost the 43 or 41% of it, right? So the debt ratio, just like we had equity shareholders funds upon net assets, here it is going to be total debt upon net assets. Total debt upon net assets. Now here, debt is, over here, it's 13 lakh and 20 lakh. And if I want to take this ratio over here, I can say total debt is this. Net assets is basically your total funds that you have invested. Yeah. And then that will give us this numbers, which are of course the balance portion of it, right? So not the balance portion basically, because we also have the preference share, right? So debt ratio is only the proportion which is funded by the debt. Had it been a case that you don't have preference share, then they would have complemented each other. Preference share is not included in equity ratio. Preference share will be included in another ratio, which is called as proprietary ratio. Right? So there is another ratio called as proprietary ratio. Proprietary ratio, the definition is proportion of net assets which is funded by owners. Now, when we say owners, we are going to include the preference share capital. So proprietary ratio is going to be equity share capital plus reserves plus preference share capital. This entire thing divided by, you can say, net assets. Okay, proprietary ratio. Remember, in proprietary ratio, you include preference shares, whereas in equity ratio, you don't include preference shares. Now here, when we are calculating the proprietary ratio, we will definitely include the equity share capital plus the preference share capital plus the reserves, and then divide it by the net assets. So here the numbers will be 0.69 and 0.53. So they are definitely going to complement each other, like the debt ratio and the proprietary ratio. So generally, you will find the debt ratio and proprietary ratio are complementing with each other. Okay. So preference share is not included in debt. Preference shares is a type of owned funds itself. So therefore, that is included in the proprietary ratio.
Recording
okay.
stopped.
Hello. Okay, oh, connecting to cloud server is coming something. Okay, anyways. So we have this equity ratio debt ratio, and proprietary ratio covering up over here. Then apart from this, we have another ratio to look at called as debt equity. Now this is quite intuitive and quite easy enough, because as the name says, equity ratio. For equity ratio, we had equity upon the net assets. For debt ratio, we have the proportion of debt, which is total debt upon net assets. As the name says over here, debt equity ratio. Here, debt equity ratio means, of course, in the numerator, you will have something called as debt, and in the denominator, we'll have the shareholders' equity. So this means debt funds upon equity shareholders' funds, or we call it as simply borrowed funds upon equity shareholders' funds. Okay, so this ratio is again an indication of long-term solvency. But before we go ahead with this, can you tell me, out of X and Y, which one is having long-term solvency as compared to the equity ratio? With regards to equity ratio, which of these two is having a greater degree of solvency? Level of long-term solvency. Which company is having a greater degree of long-term solvency? The long-term solvency over here is high, and here it is low. Then same conclusion we can draw even by looking at the debt ratio, because the lower the level of debt, better will be the long-term solvency. And even by looking at the proprietary ratio, you would be saying the same thing, because proprietary ratio is high. It means owned funds is higher and borrowed funds is lower, right? Fine. So debt equity ratio is also what we have covered here right now. Debt funds upon the equity shareholders funds. Fine. So we can compute for this example also, debt funds is 13 lakh upon equity shareholders funds is also what we have computed as 25 lakhs. So for this company, we can say debt is 13 lakh and equity shareholders funds, it includes the equity share capital and the reserves. So total is 25 lakh, and we get this number as 0.52. So 0.52 means for every rupee 1 of debt, company has rupees 0.52. Sorry, for every rupee 1 of equity, or for every rupee 1 of equity or equity shareholders fund, company has 0.52 of debt. Okay, so this scenario essentially indicates that your debt funds are 52% of your equity funds, whereas we can apply the same for this company also. And here we observe that the ratio is like 1.17. Like for every 1 rupee of equity, you have 1.17 of debt. So this is quite a risky scenario, right? This is quite a risky scenario as compared to the first ones, and therefore that has been our conclusion right since we computed the equity ratio, that the second company is relatively long-term solvency for the second company is relatively lower, right? Now again, it will differ from industry to industry and also from the perspective of the business that company is into, right? But a general comparison between the companies can be made by these ratios. Okay, now before we go ahead, well, let's take a short break now over here, because we are going to understand a really interesting concept called as capital gearing, right? So before that, let's take a short break, and post that we'll get started with this concept of capital gearing. Okay, before I go for a break, Hardik, you have any query? Hardik, you have raised your hand.
Good evening, sir. Good evening, sir.
Good evening,
Sir,
Hardik.
Sir, for comparability of a ratio, it is true that we must have the same estimates of a different company balance sheets, then only we can compare.
Correct. So we can compare like previous year values with current year values, or we can compare value
No,
of
sir, not for inter company. I am asking for intra company.
intra company. So how are you going to compare a company with itself?
Sorry, sir, inter company. मतलब company with a different company in the same industry.
Yeah. So then you need two companies to compare, or maybe you will take an industry average. What is the average of all the companies, and where do we stand as compared to the average?
Okay, sir. Thank you.
Sir, in debt equity ratio, whether debt from current liabilities is not included or not, sir?
Debt equity ratio.
Debt from current liabilities.
Yeah, it will include total debt. Total
But
outsider
even-
debt. Total outside debt, like your
current liability 1 lakhs was not came here, sir, in debt equity ratio.
no. Generally, it will be always long-term debt. But if the question specifies, we may also consider the short-term debt. But in general sense, we take it as a long-term debt.
Okay, works.
Okay.
So
Yeah.
in debt ratio, what you said, like higher the better or lower the better in debt ratio?
Debt ratio lower. If the debt ratio is low, it indicates greater degree of solvency.
Thank you, sir.
Okay.
Hello, sir.
Yeah.
Sir, what is the difference between quick asset and net current asset?
Net current asset is your current asset minus current liability. And quick assets are all the current assets except stock and prepaid expenses. Okay.
Okay, sir.
Yeah.
Sir.
Yeah.
Sir, one small thing I want to ask. Sir, in fictitious assets, do we include deferred expenditure as well?
Deferred expenditure. What sort of deferred expenditure are you talking of? Like deferred advertisement expenditure.
Like sir, development expenditure, advertisement expenditure, which we
If you
take
have
for a
kept
longer
it-
period of time.
Yeah, if you have kept it on the balance sheet asset side, then you need to remove it because it's definitely a fictitious asset.
Okay, sir. Thank you, sir.
Sir, hello, sir.
Yes.
What is, sir, non-cash expenses, sir?
Those expenses which you don't pay in cash, like in depreciation, you charge depreciation to your assets, but do you pay depreciation in cash?
No, sir.
No. So all those expenses which you don't pay in cash are your non-cash expenditure.
Sir, amortization are include, sir?
Amortization is a non-cash expense. Just like you depreciate your fixed assets, similarly, intangible assets are amortized.
Sir.
Okay.
Thank you.
Okay.
Hello.
Yeah.
So why these ratios are called as a long-term solvency ratio? So as earlier we have studied about the current assets ratios. It studies about how we are going to pay, how we are going to liquidate our current assets
What is
and
our
pay
capability? What is our capability to honor our current liabilities?
Current liabilities.
So
but in this case,
we are looking at our capability to honor our long-term liabilities.
But here we are not going to sell our assets and pay our
no, you're not going
debts,
to
right?
sell your assets, but you're going to we are comparing the total assets as compared to the equity shareholders funds or as compared to the debt. Right. So you have total 43 lakhs assets, out of which 13 lakh is debt funds. So again, it's similar to like that only.
Okay, sir. It means it picturizes that what portion will be covered by what,
yes,
financed by what kind of.
Correct.
So thank you.
Hello, sir.
Good evening, sir.
Yeah, Tanya.
Sir, what is the difference between quick assets and absolute liquid assets?
Quick assets and absolute liquid assets. Yeah. Quick asset will be your current asset minus stock and minus prepaid expenses. And when you are excluding debtors from that, that will be your absolute liquid assets. So basically, those assets which you can liquidate it immediately.
Okay, sir.
Hello, sir.
Yeah.
Sir, in debt equity ratio, the lower is better or higher is better?
Debt equity ratio, lower indicates greater degree of solvency.
Okay, sir.
Hello, sir.
Yeah.
I'm audible, sir.
Yeah, Vijay Lakshmi, you're audible.
Sir, liability is lower and asset is more than, so it is long term company.
Sorry, didn't get you. Liabilities is more.
No. Liability is less. Debt is less and equity and preference share is
High.
more. So it
It
long term.
indicates greater degree of long-term solvency. Yeah.
Sir, how many types of quick asset ratio, like a basic defense ratio, like that, sir?
How many types of quick asset ratio? There is only one quick ratio.
Then basic defense ratio has come under which category, sir?
Under short-term solvency ratio. Under short-term solvency, you have current ratio, you have the what to say, liquid ratio, absolute liquid ratio, and basic defense interval.
Hello, sir.
Daily
Yeah.
operating expenses, it's a formula for basic defense ratio, quick
Yeah,
asset.
yeah, because in the denominator you have daily operating expense, right? So to compute that, you first need to work out this.
Thank you.
Okay.
Hello, sir.
Yeah, Tanya.
Sir, what is the ideal ratio of the absolute liquid ratio?
Ideal ratio is 1.
For quick and absolute for both?
Yes, we should have at least, we should have 1 ratio, because even if you have 1, you will be able to honor all your current liabilities.
Okay, sir.
Okay, so let's take a short break, guys.
Yes, sir.
We'll take up your queries in the last part of our session, okay?
Sir, one doubts.
Okay, so welcome back, guys. We were looking into the long-term solvency ratios. Now, before we go for the next ratio, I would like you to go through a income statement that we prepare for basic understanding how the company is earning revenue and where the earned revenue is essentially going. Okay, so the revenue starts from the sales that is generated by the company. Okay, so suppose a company is having a sales of 20 lakhs. Okay, suppose the company is having a sales of 20 lakhs. Now, out of this sales generated, where would you utilize the money? Obviously, we need to pay initially the variable cost, right? So variable cost is suppose 8 lakhs. And then we have the contribution. So contribution is 20 lakhs minus 8 lakh, which is 12 lakhs, right? And then from that, we deduct the fixed cost. So the fixed cost is, let's assume it to be 4 lakh. So that will give you earnings before interest and tax. So earnings before interest and tax will work out to be 8 lakh. So now when we have the sales of 20 lakh, from that you are incurring an expenditure of 8 lakh on the variable cost. Whatever is left out is the contribution, which is 12 lakh. From that contribution, you pay the fixed cost, and then you have the earnings before interest and tax of 8 lakh. Now, till this stage, dear students, till this stage, whatever numbers we have, like the sales, the variable cost, the contribution, fixed cost, EBIT, all the numbers are dependent on your operating decisions. What are your decisions with regard to operations is going to impact over here. If you are employing more of labor force, of course, variable cost will be higher. If you are having more of mechanization or machinery into your business, fixed cost will be higher due to the higher depreciation. So whatever these numbers are, those are influenced by your operating decisions. The way you have funded your business, whether by equity shareholders fund or whether you have borrowed, that is essentially not going to have any impact on these numbers, right? So sales is never going to get influenced by whether you have taken a loan or not. Your variable cost, your fixed cost is not going to get influenced by whether you have taken a loan or not, or whether you have funded it fully by equity shares. So all these numbers, this portion entirely, this is just operational in nature. So this entire portion of your income statement is due to the operations. Now, since we have this number as EBIT, this is a, the border line. There's the border from before which all your operating items are there. And after this, all your financing items are going to come. Any guesses what is going to be subtracted from earnings before interest and tax? Any guesses what is going to be subtracted from earnings before interest and tax? Interest. Perfect. We are definitely going to subtract all sort of interests. I'm definitely going to subtract all sort of interest, guys, right? So the interest is, let's say we have borrowed some money and on that we're paying an interest of suppose 3 lakh. So after subtraction of interest or finance cost, we get profit before tax. So profit before tax is 5 lakh. Any guesses what are we going to subtract from profit before tax? Any guesses, guys, what we are going to subtract from profit before tax? Yes, taxes. tax on income, right? So let's say tax subtraction. Let's say the tax rate is at the rate of 30%. So tax is going to be 30% of this. And then we have profit after tax, right? So profit after tax. Profit after tax will be 3,50,000. Still, this is not your final figure. We are further going to subtract something from this. Can anyone tell me what are we going to subtract from profit after tax? What are we going to subtract from profit after tax? Yeah, preference dividend. Perfect. So preference dividend will be subtracted. Suppose we are paying a preference dividend to the tune of 1,20,000. So what is left over is net profit for equity shareholders. So 3,50,000 minus 1,20,000 is what is left out for the equity shareholders. Now, all these numbers starting from interest till your net profit for equity shareholders. So all the numbers beginning with interest till the net profit for equity shareholders, all those numbers are going to be due to your financing decisions. Okay, so this is going to be due to the financing decisions, and this portion is going to be determined by the simple fact how much you have borrowed, whether you have borrowed and what is the amount of borrowing that you have undertaken. That borrowing and what amount of preference shares you have issued, that is going to have an influence on these numbers, and these set of numbers are going to be purely based on your financing decisions. These numbers are going to be based on your financing decisions. Okay. Fine. So now what are we really trying to look over here? If I ask you, who all are providing funding for our business? There are three categories. One, you can say the owners. Even within owners, you will have, even within owners, you will have like equity shareholders and preference shareholders, and outsiders, which are the debenture holders. If I ask you, the company has earned 8 lakh as earnings before interest and tax. Company is earning 8 lakh as the earnings before interest and tax. Who is having right over these earnings? Who has a right over these earnings, guys? Company is earning this 8 lakh rupees for whom? This 8 lakh rupees is earned for whom? This is for all the fund providers. Am I right? Sir, EBIT, earnings before interest and tax, is earned for all the fund providers, out of which first right is that of the debenture holders or the borrowed funds. But from this EBIT only, you're going to pay to debenture holders, you're going to pay to the preference shareholders, you're going to pay the equity shareholders. So this EBIT, is earned, or this is a earning for all fund providers. So 8 lakh, which is EBIT, is an earning for all fund providers. Then we have this profit after tax, this figure. Tell me, this is a earnings for whom? 3,50,000 earnings of the company is for whom? Can I say this is for all, or I can say this is earnings for all owners. This is earning for all owners, shareholders, total shareholders, all shareholders. And finally, we can say this last figure, net profit for equity shareholders, 23 lakh. This is earnings for whom? This is earnings for equity shareholders. Right? This is earnings for equity shareholders. Now, if I ask you one thing, I'm just building up a base for a really interesting ratio, guys. Okay, so just have some patience. We're just trying to build up a base about some ratio. How do you get the rate of return earned? Right? How do you get the rate of return that you're earning? Like, for example, if I tell you, you invested 10 lakhs somewhere, right? And you received a income from that of 1,50,000. How do you get the rate of return earned? What's the rate of return that you have earned? You have invested 10 lakh and you received 1,50,000 as return. How do you get the rate of return? 15%. So that 15% is nothing but income upon investment. Am I right? Because the rate of return that you earn is essentially 1,50,000 divided by 10 lakh. That's nothing but 15%. But we can say it's a rate of return is computed as income upon investment. Correct. I hope it is clear, everyone. Yeah, income upon investment. This is a basic fundamental that we are talking about. Now, if I'm asking you, what is the rate of return earned by equity shareholders? Rate of return earned by equity shareholders. Rate of return earned by equity shareholders. I don't want the numbers. I want you to give me the logical formula for it. The formula is simple. Numerator, it has to be income. Denominator, it has to be investment. Right? So this is income upon investment. What is income for equity shareholder? From the income statement that we prepared, which of these line items is the income for equity shareholders? Income for equity shareholders. Which of these line items? Can I say net profit for equity shareholders? You can see the name itself is net profit for equity shareholders. So income is net profit for equity shareholders. What is the investment that equity shareholders might have made in the company? How do you measure the amount of investment that equity shareholders might have made in the company? What is the amount that equity shares have invested in the company? Sir, equity shareholders funds. Because whatever is the amount of, you have equity share capital and reserves. What is the amount of equity share capital and reserves? You take it, club it together. That's the capital, that's the investment which is made by the equity shareholders. Because in the balance sheet, fundamental balance sheet equation we have stated over here, equity shareholders funds is equity share capital plus reserves minus fictitious asset. Now, I'm not writing this fictitious asset because common understanding that you know that we need to subtract the fictitious assets. Okay. So equity shareholders funds, basically the investment made by the equity shareholders in the assets, in the assets of the company, is the equity shareholders fund. They have invested this much money into the company. Debentures holders have also invested. Preference shareholders have also invested. But we are talking of equity shareholders return. So of course, I'll be talking of investment of equity shareholders also. So that's how we compute the rate of return earned by the equity shareholders, which is net profit for equity shareholders upon equity share capital plus reserves. Does it make sense to you, everyone? Yeah. Okay. Now let me just numeralize it with further numbers. Let's say company has got an equity share capital of 10 lakh, reserves of suppose 2 lakh. Okay. And let's say preference share capital of 5 lakh, and it has got a debt of, let's say, 7 lakh. Not 7 lakh, but 1 second. 25 lakh. Okay. So total capital employed is, we can take a summation all of it, which is 42 lakh. So this is just a hypothetical numbers that we have considering over here. Okay, 42 lakhs is the total capital employed, and the bifurcation goes as equity share capital 10 lakh, reserves of 2 lakh, and preference share capital of 5 lakh, and debt of 25 lakh. Now, what is the rate of return earned by equity shareholders? We need the net profit for equity shareholders, and we need to divide by equity share capital plus reserves. So what's the return the company has earned for the equity shareholders? The rate of return which company has earned for equity shareholders, or the profit which the company has earned for the equity shareholders, can I say it is 2,30,000? Correct, guys? 2,30,000 is something that the company has earned for the equity shareholders. So we take this as equal to 2,30,000. Now, what will be equity share capital and reserves in the denominator? So in the denominator, we have 10 lakh and 2 lakh, right? So total 12 lakh is the investment. So equity shareholders have invested 12 lakh and they are getting in return 23 lakh. I mean, so not 23 lakh, 2,30,000 as return. So what's the rate of return they are earning, guys? Remember, this is always going to be in percentage terms. So can I say 19.17, 19.16% approximately? That's the rate of return earned by the equity shareholders. Okay. Is it clear? Now, let me just see how many of you can really get this ratio. I want you to calculate the rate of return earned by owners. Again, the fundamental is remaining same. Income upon investment. So rate of return, which is earned by owners. It's income upon investment. But what is the income from the line item for the owners? What is the income for all owners? Profit after tax, right? So this is going to be profit after tax. And what is the investment made by the owners? What is the amount of investment made by owners? What is the amount of investment that has been made by the owners? Can I say equity shareholders fund? You will add to it preference share capital. You will add to it preference share capital, right? So that will give a profit after tax of 3,50,000 on equity shareholders fund to be equity share capital plus reserves plus preference share capital. So total is 17 lakh. So I can simply divide it and get the answer as 20.58%. So return on equity shareholders, rate of return which the shareholders have earned, is 19.17%. All the owners in combination have earned 20.59%. Right? One last calculation I need from your end. What is the rate of return company has earned on its investments? So I want to calculate the rate of return that the company has earned on its investments. How do you get the rate of return which the company has earned on its investments? The assets which the company has, the funds that has been applied by the company, what's the rate of return that it has earned? Or I can also say this is the rate of return company has earned. The rate of return company has earned on all funds. All the funds that it has put up, what's the rate of return company has earned? I can see many of you are able to quickly answer it. Again, the same fundamental, income upon investment. What is the income which has been earned for all the investors? What is that income which is earned for all the investors? Can I say EBIT? And what is the investment made by all the investors? It is your equity shareholders fund plus preference share capital plus debt. So if you do the calculation, EBIT is 8 lakh, and then total capital employed is anyways this 42 lakhs, and we get the number as 19.04%, 19.04 or 05%. So rate of return which has been earned by the shareholder on the investments is 19.05%, guys. Are we able to get these three numbers, everyone? Are we able to get these three numbers? Yes. So the fundamentals are very clear. You need to take the income in the numerator, investment in the denominator, and get the rate of return earned by them. Okay. Clear? Okay. Now, an activity for you. So suppose we have a company named as A Limited, another company as B Limited. Okay. So they have got equity share capital, they have got reserves, they have got debt also. Equity share capital is, let's say, 20 lakh. Reserves are 10 lakh. Debt is 0 in case of B, as in case of A. In case of B, it is 10 lakh of equity, 10 lakh of reserves, and 10 lakh of debt. So total investment made by them in their business is 30 lakhs. Now we have got EBIT. From that, you're supposed to be reducing the interest to get the PBT. From that, you're going to reduce the tax at the rate of 30%, and then you get the PAT. Okay. EBIT is, suppose debt, let's say the rate of debt is 10%. EBIT is, suppose, 2 lakh. And that's the same for both companies. Complete this table and let me know which of these two companies have performed better. Which of these two companies have performed better? Complete this, guys, quick. Complete this statement fully and then let me know which of these two companies have performed better. Complete this statement quickly and let me know which of these two companies have performed better along with the justification. I need it along with the justification. Along with numbers. Along with numbers, tell me which of these two companies have performed better. Which of these two companies have performed better? With regards to interest, it will be debt multiplied by 10%. Profit before taxes, EBIT minus interest. Tax is 2 lakh multiplied by 30%. Profit after taxes, the difference between them. So I think this is what your PAT is, right? Correct? Okay. Which of these two companies have performed better? Company A or company B? Yeah. Can I be comparing really the PAT? You should not be comparing the PAT, guys. We need to compute the return on equity. We need to compute return on equity. Return on equity is what is the rate of return that was generated for equity shareholders. So equity shareholders point of view, we can say it is PAT divided by equity share capital plus reserves. So when we look at percentage times, of course, tax rate is 30% assumed. So what we observe is return on equity for A Limited is 4.67, for B Limited is 3.5. So we can say A Limited has actually performed better. Okay. But if the same thing I perform, if I carry out this same activity, by taking the EBIT as, let's say, 4 lakh. So now what we find is the rate of return is quite different. So 4.7% for A Limited. So earlier A Limited was better. Now when I changed the EBIT, B Limited has become a better performing company. Are we able to see that? Of course, I've done this in Excel. Now can I say rate of return on B is better? But one thing pertinent to be noting is, sir, PAT is still higher in A Limited. Profit after tax is still higher in A Limited. But percentage wise, the return of A Limited return on A Limited equity shares is less. Am I right? Are we all able to observe that? A Limited PAT is 2,80,000. B Limited PAT is 2,10,000. So we are like quite, it's something new that we are observing. Sir, in spite of having high PAT, we find that rate of return for B Limited is higher and rate of return for A Limited is lower. Now, why is it so? Why is it so that return of A Limited shareholders are higher as compared to A Limited? Return of B Limited shareholders is higher as compared to A Limited. We will take this concept in our next class, guys. I'll leave this with a suspense for you. Now it's time for the queries discussion. I'll resolve this suspense in our next class, guys, as to why B is performing better as compared to A. What is the reason for that? Okay, the exact reason with all numbers, with all clarity, we'll be discussing that. Now it's time for any queries. Please raise your hand. You can ask your queries, guys. Yeah. Yeah, Balachandar.
Sir, good evening, sir.
Good evening, Balachandar.
Sir, the return on equity is calculated by adding the equity shareholders' capital and plus reserve.
Return on equity. Yeah, return on by equity shareholder is added in the denominator equity share capital plus reserves. Yes.
Why should reserves be added, sir?
Reserves belongs to whom?
Reserve belongs to equity shareholders. But
exactly. So that is what. How do you get the reserves? Reserves have been arrived because you have earned profits, but you haven't paid out. So that money is actually belonging to the equity shareholder, which you have retained in your business. So that is the investment which is made by equity shareholders in your business, because you haven't paid them out.
So then rate of returns on earned by owners reserves sir.
Even there also reserves is included because we are stating their equity shareholders fund. So in equity shareholders fund, you include the reserves.
Okay, sir.
Okay. Preeti.
Good evening, sir.
Good evening, Preeti.
Sir, can you just explain long-term solvency once again?
Long-term solvency.
Yes, sir.
Long-term solvency is comparing your long-term debt and long-term sources of funds with something else. Like in equity ratio, you are comparing what is the amount of equity shareholders fund is there as compared to the net assets. Like in first company, you had 43 lakh of total funds invested. Out of it, 25 lakh was from the equity shareholders. So there you had the ratio as 0.5814. It means for every 1 rupee, if you have 1 rupee asset in your business, out of that 0.58 is due to is due to the funding from the equity shareholders, whereas in the second case it is 0.39. So of course, higher equity ratio means higher proportion of owned funds in the business. So higher proportion of owned funds will lead to greater stability and greater liquidity. Same goes even with the debt ratio, because there we compute what proportion of our net assets is funded by debt. So out of total assets, out of net assets, how much is funded by debt, that is computed. Proprietary ratio is computed as proportion as a owners, because in equity ratio we just considered equity shareholders, whereas in proprietary ratio we consider all types of owned funds. And debt equity ratio is a comparison between debt fund and equity funds. Okay, so essentially we are just trying to know what proportion of our debt or equity is compared to the total funds.
Sir, in this net assets, do we include fictitious asset?
No, in net assets you will be taking only fictitious assets is never considered. In fact, when you're calculating reserves, fictitious assets will be subtracted from that.
Got it, sir. Thank you.
Okay, Rosaline.
Good evening, sir.
Good evening, Rosaline.
Sir, last one, the rate of return on investments. Just tell me once again that I missed somewhere.
Okay. If you make an investment of 10 lakh and you earn an income of 1,50,000 on it, how do you compute the rate of return?
Means income divided by investments.
Simple. So income divided by investment. So same way we wanted to know what is the rate of return earned by equity shareholder. So equity shareholders are having an investment of 10 lakh and 2 lakh reserves. So total 12 lakh. On that 12 lakh, the company has earned 2,30,000 as a return for them. So what's the rate of return they are earning? Can I say 2,30,000 divided by 12 lakh, which is
Divided by 12 lakh.
0.17.
The last one, sir, only rate of return has earned on total investment.
All funds, yeah. So total funds that have been invested is 42 lakh in the business, right?
Is total, it's on total capital employed.
Yes, it's total capital employed, yes. Okay,
So what is contribution?
Total capital employed is 42 lakh. On that, company has earned the EBIT. And from that EBIT only, you're going to pay other portions.
Sir, what is contribution? After break, you use the word.
Contribution, yeah. Sales minus variable cost is contribution. Just like your sales minus COGS gives you gross profit, right? So
Yes,
it's again
sir.
a measure of type of profit where only variable costs are subtracted.
Okay, thank you, sir.
Okay. Yeah, Vinuta.
Sir, once explain, sir, optimum current ratio.
Optimum current ratio.
Yes, sir.
So we found that current ratio, higher it is, the better it is, because you have more current assets, you will be able to easily pay your current liabilities. But keeping very high level of current ratio is also problematic, because if you have very high current ratio, what will that indicate? That you are having a lot of stock, a lot of debtors, a lot of cash, and those are indicating your inefficiencies. So we don't want our current ratio to be very high, neither to be very low, and therefore optimum level is stated for a manufacturing entity to be 2:1. Okay.
Hello. Okay, sir. Got it.
Okay.
Hello.
Thank you, sir.
Yeah.
Sir, liquidity means, sir.
Yeah. Who's this?
Sir, liquidity means available in cash, sir. But our ability to pay the obligations, sir.
Liquidity means your ability to pay the obligations.
Okay. Liquidity and solvency both are same, sir.
Yeah, on the similar lines. Yeah.
Okay, same, sir. Or any differences?
Liquidity is almost they are on the same lines only. For our understanding, as of now in the ratio, it is same. Okay, but when
sir.
you say
But
both of them are talking of the same thing, whether you will be able to pay the obligations as and when they come.
Okay.
Okay.
So what is different between angel investor and that venture capital?
Angel investor comes at a very starting stage when you're starting the business. Venture capital comes when your business is, almost set and your product is ready. When you have just an idea to start your business, but you haven't yet started it, that time you have angel funding. But when you have started your business, you have started selling goods, manufacturing, then you need money for expansion, then you go to venture capitalist.
Thank you.
So when the company go for debentures and when it go for preferential shares, sir, what is the base for that?
That discussion will take it up in the chapter of capital structure.
Okay.
There we'll be discussing whether to go for equity funding or debt funding, or a combination of equity or debt, or to involve preference share in data.
Okay, sir.
Okay.
Hello, sir.
Yeah.
Sir, in page 3.10, the debt to equity ratio, there are many types of formula. They're called the total outside liability upon
Correct.
shareholder equity.
So generally,
Sometimes they say
generally
long-term debt by shareholders equity. Why, sir? This
because see, these ratios are formulated by the authors. So multiple authors have given multiple formulae for that, right? So as I said, in general sense, we'll take the long-term debt unless the question specifies that you have to take other debts also. Right? So authors have given different opinion whether to include short-term debt or not, whether to include outside liabilities. So therefore, we have such ratios, but in general parlance, it will be long-term debt.
Hello, sir.
Yeah. Yeah, Tambeshwari.
Yes, sir. CR is negative, so sir is insolvency company is
No,
going in.
CR is, how can the current ratio be negative? If you're saying current ratio is negative, your current asset is negative. How can your current assets be negative? You can have maximum current asset to be 0.
Assumes that the sir
Assume what?
asset is no one.
Asset is not there, so asset value is 0.
नहीं सर कभी कभी ऐसा होता है ना कि असेट नहीं है तो कंपनी इंसॉल्वेंसी हो जाती है, दिवालिया हो जाती है.
अरे तो you should have an asset, right? When you're talking of current ratio here. Formula is current asset upon current liabilities. When you don't have current asset will be 0. Current liability value may be anything, but your current ratio will become 0.
Oh, sir. Thank
right?
you.
Possibly you are talking of current asset, current liability.
Hello, sir.
Yeah, Dilip.
Hello, sir.
Yeah, Dilip.
Hello, sir.
Yeah.
Sir, what are the other borrowing funds, sir?
Arup, what are the
other borrowing funds?
Other borrowing funds?
Yes, sir.
Where do you find this term, other borrowed funds?
Sir, page number 3.11, sir. Sir, capital gearing ratio, sir.
Capital gain ratio we haven't yet covered, beta. Hold on.
Okay, sir. Okay, sir.
Yep. Nayan?
Hello, sir.
Yeah, Dilip. Dilip or Nayan, anyone?
అందుకనే మనకు కొంచెం వెయిటేజ్ అవుతుంది సార్. Sir, can you please explain fictitious assets?
Nayan?
Hello, sir.
Yeah, Nayan.
Sir, how can we get previous lecture notes?
How can you get?
Previous lecture notes.
That is already there on the portal. You can find it on the portal. BOS
Sir, I
portal,
find, but I don't get it.
No, it is uploaded. You can see.
Okay, sir.
So,
Yeah.
What is bad, bankruptcy or insolvency?
Bankruptcy is basically when you don't have assets to pay off your debt. When your assets are less than your liabilities.
Insolvency?
Insolvency is when the court declares you, or rather bankrupt is, both of them are same. Bankruptcy is a legal term where the the court will declare you to be bankrupt.
Okay.
By taking into account your assets and liabilities.
Okay, thank you.
Yeah. Yeah, Vijayalakshmi.
Can you list out what of the ratios are we covered in today's class, sir?
I will upload this Excel file, Vijayalakshmi, on the portal. You will find it easily.
Okay.
మనకి 30 కానీ లేకపోతే పార్ట్ టైం అయినా సరే
Yeah, Dilip. Fictitious assets. Fictitious assets are those assets like your preliminary expenditure, discount on issue of debentures which you haven't charged to P&L and you have kept it in the balance sheet on the asset side. Yeah, Sumit Kasak.
Good evening, sir.
Yeah, yeah, Kasak.
So, what do you mean by net receivables?
Net receivables.
Yes, sir. Is it the bill discounting or the value that you get?
No, net receivables is your value of debtors plus bills receivable minus any provision for doubtful debts that you would have provided for.
Okay, sir.
Okay. Sumit.
Hi, sir. Hi, sir. Sir, what is difference between liquid ratio and absolute liquid ratio?
Difference between liquid ratio and absolute liquid.
Yes, sir.
So in liquid ratio, you are only subtracting the stock and prepaid expense from current assets. So your debtors is still there inside it. But in case of absolute liquid ratio, you are excluding the debtors, you're including cash and cash equivalents and marketable securities only.
Okay. Thank you, sir.
Okay.
Sir, no.
Yeah, Satish.
Sir, negative working capital indicates what, sir?
Negative working capital simply indicates that your current asset is lesser than current liabilities.
Okay.
So you are having something to pay, but you don't have assets to pay them.
Okay.
Okay. मस्त गाना बजा रहे हो तुम. What are the effects of advance income in all ratio? Advance income will be a current asset that will impact wherever you have current assets in it. As we have idle current ratio, does we have idle debt ratio and other ratio? No, idle debt ratio is not there. So you won't, that will differ from industry to industry and also the business that the company is into. You can find these notes. I'll be uploading it after today's class on our portal. Yeah, Rachna. What is marketable securities? Marketable securities are those securities which you can, sell it in the market easily without loss in the value. So like some liquid funds, government securities, which you are holding it for the purpose of easy liquidation. Operating expenditure means day-to-day expenditure. Yes, all the expenditure that you need to run your businesses, to keep running your business, like your purchases, your salary to staff, all right, all of them are your operating expenditure. Notes are not visible. This will not be visible. This I will be uploading it after today's class.
Sir,
yes,
sorry to interrupt.
Yeah.
But sir, previous class notes are also not there.
Previous class notes? I mean yesterday's class?
Yes.
Yes, sir.
I don't think so. It should be there because I've already uploaded the PDF. Probably it will come to you by tomorrow maybe. So it will take a day for processing possibly, and then you'll be able to view it.
Sir,
Okay, sir. Thank you.
Yeah. Yeah. Yeah,
Sir,
Balachandra.
fictitious assets include goodwill, sir.
Equity shares, goodwill. Goodwill is an asset, beta.
Sir,
It's an intangible asset. How can you add it with equity?
Sir, fictitious asset, sir.
Huh?
Goodwill is fictitious asset.
Sorry?
Fictitious.
Fictitious asset.
Yes, sir.
No, goodwill is not fictitious asset. Fictitious assets will be your preliminary expenditure, discount on issue of debentures which you have not written off, all of that will be
there. I did not get this, sir.
So Does there exist any other asset other than stock and prepaid expense which needs to be reduced from current assets? No. For quick ratio, only you need to subtract the stock and prepaid expense. Few examples of marketable securities: government T-bills, treasury bills, or any units of a debt mutual fund, or any securities, debt securities which are easily trading in the stock exchange and you can liquidate it easily. Okay. Any other queries, guys? Minutes.
Sir, hello.
Yeah.
Ideal ratio, the term we used in our session, sir. Ideal ratio,
which ratio?
Ideal ratio.
Ideal ratio, yeah. Ideal, it's an optimum ratio that we are talking of. So optimum ratio of current ratio is 2:1. For a manufacturing entity, it is generally acceptable to have a current ratio of 2:1, and that indicates some sort of acceptable degree of liquidity.
Ideal current ratio means same.
Optimum current ratio.
Optimum current ratio.
Yeah. Because we said current ratio can't be too high, it can't be too low.
Sir, generally that from shareholders, the company is collecting equity share and on premium, sir. Instead of at the time of inception of the company, they are collecting share capital with the premium, but dividend is payable on face value only.
Correct.
But we are saying that cost of capital we are telling, but that premium we are not considering. How it is like that, sir?
Where have we covered cost of capital better today?
No, not today, sir. I'm asking general doubt.
No. In when you calculate the cost of capital, there are different bases. So you consider the market price of the share and not the equity share capital. Not the
what about the premium, sir? Premium also will be considered there.
When you say market value, it includes the premium, right?
Okay.
Okay. Are we good? Shall we call it a day, Vibhor?
Sir, in the denominator of proprietary ratio, will we take net assets or total assets?
In the denominator of?
Proprietary ratio.
Proprietary ratio.
In the class 12th, we have read total assets. We took total assets in class 12.
Proprietary ratio.
But yes, sir.
So proprietary ratio, that again, it may be a case of net asset. It can be also a case of total assets. But generally, we take this proprietary ratio as total assets, which is total of all the assets, because we want to know what is the funding given by all the owners.
Yes, sir.
Okay. Fine. So I think we are all good to go for the day. Have a great weekend, guys. See you soon in the next class. Thanks for your compliments. Yes, sir. Over. Good night.